Hey, before we get started, I want to talk about some bad actors in our industry. These actors are disguising themselves as financial advisors, and they're really just financial salespeople, and they're trying to sell annuities. Annuities are products generated by insurance companies, which are really good for the insurance company to sell, and it's really good for the advisor or salesperson to sell to you, but it's not that great for you. We have a white paper on our website, Buyer Beware, at the very bottom of the website. Put in your email, and we'll send it to you on why you should stay away from these annuities. Thanks for listening. Welcome to the Wiser Wealth Management Roundtable. We believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom are my co-hosts, Brad Lyons and Matthews Barnett. Hey, guys.
Hi, Casey.
How's it going?
So this is our first episode inside our new space. So what better month to do that in financial literacy space, literacy month, if I can spit it out.
Well, I don't know about that, but it was certainly good timing.
So just to be clear, same office. I don't want to freak anybody out going, where'd they go? Same office, just we have a new studio that is still being built out. And our wonderful editor, Heather Harrison, is going to get the all the echoes out until we get our sound tiles in. All right, so we have a lot to cover. So this topic today is 25 financial terms everyone should know.
Well, Casey, our industry, like all industries, has a lot of jargon. But for some reason or another, the financial services industry just seems to have more than most. It's just part of the business that we're in. We use it on a regular basis, but we have to keep in mind that the general public may not be as used to some of these words that we use all the time, and they need to be brought up to speed on some of it. Simple things that we hear on a daily basis are bull market and bear market, for example. We take it for granted that everybody knows what that means, but it may not be the case. And so when we're talking to clients and we're talking to our listeners as we are now, we need to make sure that they have the same level of literacy that we do. And this is Financial Literacy Month.
There's a lot of acronyms, too. They like to throw in acronyms that we take for granted, but a lot of times if you're not in the industry, you don't understand that either. So there's a lot of terms out there for sure.
You know, the bull market, bear market reminds me of the story that during the financial crisis, things got you came to work and you just felt like you were beaten up. I look forward to the weekend when there was no trading, right? But I remember walking in and my 3-year-old looking at me going, did the bull come today or the bear? And I was like, well, maybe my emotions are affecting the household more than I would like. When my 3-year-old's asking me, did the bull come today or the bear come today? I was afraid to say bear. He might run to his room.
Yeah.
Okay, so let's get started. We got 25 terms that we think everyone should know about personal finance. So first one, in life, there's life, liberty, pursuit of happiness, and the fourth guarantee, compound interest. We'll start there.
It's like the eighth wonder of the world.
That's right. So if you're trying to tell somebody what compound interest is, how do you explain it?
Well, it's allowing the interest earned on your money in the first period to remain invested in the amount of money you have to earn interest again on the second period, which then earns interest in the third period, and so on and so on. So you can think of it as interest on interest.
That's right, and that's a lot of people don't understand that or think about that. It's the same thing if you ever looked at a chart. Somebody that saved when they're 25 up till 35 actually has more money in retirement than somebody who started saving at 35 through 65 in retirement, just because the earlier that they started investing, that time is how time to accrue that interest on interest, like you said, and it makes a huge difference over time.
Really helps young people. Older you get, the less compounding you get. So that's important to remember. We're kind of jumping over a lot of different things here, but we'll move to the next one. FICO scores. People go, what's a FICO score? Do I got that one?
Yeah, I think so.
I think I have that one. So FICO score is basically your credit rating. People say, what's your credit rating? Do you have enough credit worthiness to get a loan? It's an acronym. Actually, it's the Fair Isaac Corporation, a company that came up with the methodology for calculating the credit score based on several factors, including a person's payment history, length of credit history, and then total amount owed. I think obviously a FICO score is important to maintain for buying a house and maybe a car, but outside of that, we like to see people living a Dave Ramsey-like debt-free life going forward. So I think the older you get, the less the FICO is probably is important, although that's probably when it's the highest, is if you establish some credit. But the scores range from 300 to 850. Obviously, the higher the score, then the better your credit. People with scores below 620 may have a harder time getting credit at a favorable interest rate.
And you can find those on like an Equifax. They'll do some credit cleaning to help you boost those scores. You've probably seen the commercials on TV. And also, most banks have done a good job now of having like a dashboard once you sign on to the app of showing you, providing you a free credit score to see what you are, and kind of it'll give you some suggestions on ways you can help improve it.
So let's talk about net worth. When someone says my net worth is X.
Well, net worth is simply your assets minus your liabilities. So when you look at your household net worth, what you're looking at is a balance sheet the same way that a corporation might look at their balance sheet. You have your assets, which is your bank accounts, your investment accounts, your IRA accounts, plus the equity in your home. And you have your liabilities, which may be your mortgage, your car loan, and student loans are three good examples there. And it's the liabilities and assets put together, which gives you a net worth statement.
I think this is harder for most people. Asset allocation. You think about asset allocation, people think the number of banks that they do business with, and I've always wondered why they thought that. But asset allocation is how you allocate your investment portfolios. So, for instance, there's large cap stock, mid cap, small cap. There's foreign stock. There's emerging market stock. That's Brazil, Russia, China, India. And there's bonds. And there's various types of bonds: short-term, intermediate, long-term, mortgage-backed bonds, as well as foreign bonds. So when you think about someone's asset allocation, are they properly diversified amongst all those asset classes that match whatever their risk tolerance is? Where a lot of times you'll see people build portfolios in their 401k plan. They have 4 funds that they've chosen, but they're 4 funds essentially owning the same type of stocks.
They're all overlapping.
Yeah. 401k plans have gotten so narrow now that it's harder to do that. But if you think about, if you had a large cap fund, and then you had a large cap growth fund, then you had a large cap value fund, and then you had a fund that was maybe a dividend focus, and they pick up all 4 of those because they're only looking at rate of return, you end up owning the same companies in different funds. So that's not good asset allocation at all. And then I forgot to add real estate. Real estate, either actual real estate or also real estate.
REITs.
Publicly traded real estates in a portfolio.
There have been a number of academic studies done on asset allocation. They've determined it is the number one determinant of your returns over the long period of time, and that over 90% of the return you receive comes simply from the asset allocation that you've chosen for your portfolio, regardless of what's the mix of particular securities are in the portfolio. It's the allocation between stocks, bonds, and cash and real estate, as you mentioned, that is over 90% determinant.
And that allocation is usually determined by your risk tolerance and your time horizon of how long those funds will be invested. So that's kind of how you come up with the proper asset allocation, and then you can divide it between asset classes from there.
Bonds. So I think I don't think they taught me much about bonds in my college education. It's something you kind of gathered outside of the classroom, or maybe they did and there was no real life application of it. But bonds is something that I had to go to school on myself once I was managing portfolios. There's so many different types of risk. People think that bonds are just always super conservative, but essentially the basics of it is you're going to lend money to a company. The company is going to pay you interest on that money until a certain date. At that date, which is called the maturity date, you get your principal back, right? That's the simple. The simple is that now the price of the bond will move up and down, but on the maturity date, you always get the principal back, assuming that the company's still in business. That's what makes bonds more conservative, also subject to inflation and other things that we have to manage the risk for. But then there's short-term bonds. So Matthews, if I loaned you $1 to get a Coke and you said there was $1 in your car and you pay me right back, that's a pretty safe bet. But if he tells me he's going to pay me back in 5 years, I'll probably forget about it and probably default.
Thank you.
So the longer the term,
There goes the FICO score.
That's right.
yeah, that's the longer the term, the more risk you have. So that you should get paid a higher yield for going out further on the risk. And then there's also high yield bonds, which these are companies that have some probability of going out of business. So those are the 8+% loans typically, because they have a lot of debt and there's a chance that you don't get your money back. There's no free
there's
lunch.
always default risk, reinvestment risk, inflation risk with bonds. You're seeing a lot of questions right now with the fact of, because interest rates and bond yields are inverse right now with inflation heading higher, as interest rates heading higher, starting to affect bonds somewhat. So that's a topic right now is how are bonds going to do in the short term as well as the long term right now.
Now,
Well, the role that bonds are playing in portfolios has changed slightly over time. In previous generations, bonds were used for income. When interest rates were 6, 7, 8% on a normalized basis, that money was used for income to pay your household expenditures and to live on. Today, with interest rates as low as they are, 10-year yield on the 10-year Treasury bond is 1.6% or thereabouts. So the role that bonds play now is more of a risk mitigator in a portfolio, allowing you to step out a little further on the risk spectrum and the equity side of your portfolio.
In contrast, on this, if you compare that to stocks, you're investing in a stock. You want the price to go up because earnings of the company or revenues go up. But you could lose everything if the company went out of business, where a bond typically is secured to something. So you would get in line and wait for liquidation of assets in order to get that money back. Other one we'll move into is capital gains. Some people talk about capital gains in a stock or bonds. Matthews, you want to take this one?
Yeah, sure. So capital gains have a little preferential treatment over a short-term gain. Short-term gains would be something that's held for less than a year, and that's usually taxed at ordinary income rates. Capital gains being like a stock or in your investment account, anything above your cost basis that you bought the stock for, if you sold it, you would pay a capital gain. Like I said, that has a little preferential treatment over short-term gains. That tax rate can either be 0% if you're under a certain income threshold, 15%, or even 20% if you're in the higher income bracket. So it really just depends on your income bracket on what you'll be charged for those capital gains. That's usually when you're selling some type of security. Like I said, it usually, as long as you're holding it for at least 1 year, it has a little bit of preferential treatment over ordinary income tax rates.
Moving on to the next category, rebalancing. Brad, you know all about this.
Well, rebalancing is an interesting topic. It has directly related to what we just talked about prior to capital gains, and that being asset allocation. Your asset allocation is set in a proportionate manner in a portfolio in order to achieve a specific objective out in the future. So in order to achieve an objective of moderate gains with some current income, you may set a portfolio at a rate of 60% stocks and 40% bonds. But over time, given the fact that prices are variable in these securities that are held in the portfolio, the percentages of the proportions may change over time. So if your portfolio, you look at it and you've had good fortune in the markets and the portfolio is now 65% stocks and 35% bonds, that means that you are taking on more risk because you have a higher proportionality of stocks in your portfolio now than you had intended. So you need to trim 5% from your stock portfolio and add it to your bond portfolio to go back to the original target, 60-40% in this example.
A great example was last year. I mean, in March, we had that 30% pullback. We rebalanced portfolios then at the bottom, and then by the last quarter of the year, the inverse had happened. It had flipped again. So, you have to keep a watch on that. And I think that's what sometimes, if you're a retail client, you kind of set it, forget it. That's one of the main things after you've decided the appropriate asset allocation is remembering to rebalance to that.
Right.
Let's move into real estate terms. Number one on my list is amortization. What how would you guys explain that to somebody who doesn't know what amortization is?
Yeah, amortization is a very interesting a term, because it's something that most people are involved with over some point in time in their life, because most loans are amortized from the time you take it out to the time you pay it off. Amortization is simply the schedule of the payments that are allocated to portion to interest versus principal. So over time, as you begin paying down on the principal, the amount of interest you actually owe on the remaining loan is less and less and less. And so more of your payment that becomes allocated to principal over time. And it's designed so that on an even payment basis, the amount of interest and principal that gets paid back over the life of the loan goes to zero on the last payment.
I think a lot of times people, when they're buying a house, if you're not staying there long enough, just for a few years, then you sell it for more than you bought it. You hear people saying, oh, well, I made X on my home purchase or a home sale. Well, you actually didn't, because you're paying a majority of interest those first few years, and nobody really looks at that, I don't think.
No, they don't. A lot of times in mortgage world, we hear ARM, all caps, ARM, which is an acronym for adjustable rate mortgage. We see this occasionally, but
not as much as you used to when interest rates were higher.
Yeah.
And borrowers were hoping or betting on the fact that interest rates would go down, which they did over the 40-year period from the 70s to 2010. So it worked in their favor.
Basically, an ARM would be a really low interest rate, but you're making interest payments only. You're not applying anything to principal. So the idea is you pay interest-only payments. You have maybe capital somewhere else that is going to be freed up, and then you eventually pay down the principal. There'll be 5, 8, 10 years, and then typically they'll reset into a conventional mortgage at that point where you're paying on principal with an ARM. And also, it's important to remember that if you think interest rates are going to go up, an ARM will automatically adjust. Sometimes it's 6 months, a year, but there's a period at which they have the ability to increase the interest based on what's happening in the economy. Hey, thanks for listening. Hope you're enjoying the podcast. If you want to hear more from us, we've started a new YouTube channel under Wiser Investor at YouTube. Wiser Wealth Management, we're producing in our new studio space. This is our first actual recording here in our new studio inside the Wiser office. We have a 5 and 20 we do each week, 5 topics that are in the news that we give our opinions about, as well as the podcast is on YouTube. And then as we write blogs, we have a short video that we do with each of our blogs each week. Love to engage you there. You can subscribe and follow us online. Thank you. Well, let's do this one next. I mean, then because in comparison to that, there's fixed rate mortgages, which is more traditional, where it's just 3.5%, and it's 3.5% for life. There's no adjustment to it unless you refinance the house, unless you go back and get a new loan.
Well, not for life. The term of the mortgage.
Well, yeah, the term of the
15
mortgage,
or 30.
yes.
Yeah,
Yes.
Lifers.
that's
Right.
a long time.
Yeah. The fixed rate, it gives the borrower security, whereas the adjustable rate is less secure from a borrower standpoint, because if the rates change, you don't know what it's going to change to, and you have no control over it. But your payment changes when the fixed rate or the adjustable rate changes. Whereas in a fixed rate, it's just that it is fixed, and you can know what your payments will be for the term life of the loan.
Then the escrow. Escrow is all these terms seem so simple, but I understand why people may not know what escrow is.
Well, it's not taught in school, and if you don't have a home, it's
Right.
it's not something you hear every day.
That's very true. But you have taxes and insurance, which are required to be paid for your home, and there are some loans where you pay that on your own. But most loans make you pay that to them. They hold that for you until your tax bill's due and your property casualty payment is due. Your homeowner's insurance is due. So that's called an escrow. So it might be $300 a month added to your mortgage, and then once a year they take that out to apply it to those bills on your behalf. That way, the mortgage company knows it's being paid, and there'd be no back taxes on the house should you miss your payment or not pay, or if they have to take the house back over. So it reduces their risk by offering escrow as part of the process. Okay, let's move into maybe some more career type things, retirement savings. Let's define a defined benefit plan. So you're applying to a job, and they have a defined benefit plan. What does that mean to me?
You probably don't find a whole lot of them right now, to be honest.
Right.
You see more of the next one we'll talk about. But yeah, defined benefit plan would be something like a pension. Sometimes there's some cash defined benefit plans. But there's a formula based on the earnings, your history of earnings, the length of time that you've been at that job, as well as your age. And so based off that formula, you receive a certain amount in retirement, kind of like a pension almost. But you're seeing less and less of these right now.
Yeah, you are. Government workers are probably the few people that have them, and service workers. Defined contribution plans. So this would be a 401k. This would be typically you put your own money in, and then the company will match or also contribute a percentage of your salary. But you're doing it together. It's not like a defined benefit plan where they're just putting money in on your behalf. You're generally contributing together into a defined contribution plan. Such as a 401k or a 403b. The money sits in that account until you're typically at least 55, and you could withdraw it with no penalty. If you roll it to a retirement account like an IRA, it'd be 59 and a half. You'd have access to those funds.
There's different options too. You're seeing the Roth aspect of it as well as traditional sides. There's different ways that you could contribute in those accounts, as well as different ways you can invest those accounts. But that's kind of more the popular way of saving now. It's basically you saving for retirement, not the company.
All right. So let's say you go to a company and they offer stock options. Let's explain that.
Well, first of all, right away, you know that it's a publicly traded company because it offers common stock through the public markets. What a stock option is designed to do is to incent employees to behave and work in such a manner that they participate in any appreciation in the stock price. So it aligns the efforts and the motivation of the employee with that of the investors, properly, so that everybody participates in the increase in the stock price or any potential increase in stock price. They are literally options to buy the stock, the company stock, at a stated price in the future, but it may be priced in the present. So if you receive a stock option with an option price at $10 a share, and when the options mature at a specified date in the future, if the stock is worth $20, you're buying $20 stock at a $10 price. So
right, but it's not your $10; it's company's $10 because they're giving you typically these as performance. You're talking about more individual stock options.
Well, no, but there are many different company stock options. Those are more the qualified versus non-qualified stock options. True. And restricted stock options as well. But that's the idea that you receive it at a discounted price. Yep. That you then buy at the future price.
Right, that would be your typical ISO incentive stock option plan there. But like you said, there's also RSUs, restricted stock units. And then another one you see where you can buy stock at a discount would be ESPP, or employee stock purchase plan. So there's a lot of acronyms that I said earlier, and a lot of different options that you see at these companies. But usually it is those bigger firms, or also specifically with RSUs. A lot of times these big tech companies, you're seeing a lot of it.
Since you just threw in a bonus that wasn't on our list of 25 in employee stock purchase plans, we probably should also throw in some personal ones like IRA and Roth real quick. That didn't quite make our 25 list for some reason.
Curveball.
Curveball, exactly. But yeah, you have these in 401k plans, retirement plans that are built through their employer, but outside that, you also have IRAs, which allow you to get a tax deduction depending on your age. You can save up to $6,000 a year, right, into an IRA. You deduct that from your taxes. It grows tax deferred. So in the future, when you pull the money out, you would pay income tax on it, but it got to grow tax deferred. The Roth side of that is you pay tax now. There's no tax deduction for saving into it, but it grows tax free. You never pay tax on that money. So it typically 401k plans are now also offering Roth 401k plans. As you know, with pre-tax or Roth, people get that mixed up all the time. That a Roth IRA is separate from a Roth 401k. The same rules do not apply.
The thing to note is with the Roth, there are income thresholds where you can't contribute. So there's ways around it with backdoor Roths, another term for you there. But usually there's income thresholds.
Yep. Okay, let's kind of transition into insurance a little bit. Let's talk about permanent life insurance. Matthews, you're the last one to be licensed in such things.
Yeah, I actually still have my CLU, life underwriter designation. But yeah, permanent life insurance is oftentimes sold as an investment type product. But really it's kind of buy term and invest the rest. Permanent insurance is a fixed premium where you pay for insurance and you have that defined death benefit throughout your lifetime. So when you pass away, whatever that death benefit was, you would actually receive that. A term product would be something that has a fixed term period, whether it be annual renewable or 10 years, 20 years. And if you were not to pass away during that time period, you would not receive the death benefit. Permanent life policies are usually sold for the fact that they have cash value built into it. So those premiums are not just going to the death benefit, they're also going to a cash value component of that as well. So they build up cash value that you can take loans against or withdraw tax-free in retirement. That's kind of the way that they're sold. There's also variable where there can be investment component, universal index. So they don't make it easy with the way that the various ones that they have. But usually when you think of permanent insurance, it's usually a whole life type policy.
So let's transition and do the opposite. Well, I don't know if it's the opposite, but it's running somewhat parallel, I guess, is term insurance. So instead of a whole life policy is going to build up cash value. If built correctly, it should last your lifetime, right? But it costs a tremendous amount of money to deploy it. When you just mentioned buy term, invest the difference. So term insurance is that, but it has an expiration date. So it's really cheap. A 20-year-old could probably pick up $3 million of term life for $150 a month, where $3 million of whole life is going to be thousands of dollars a month, right? So the idea is that you would save more money into the market through your 401k and IRAs or just a brokerage account. And then after 30 years, you've accumulated enough money that you don't need to buy. You don't need insurance anymore. So that's where the term comes in. And the phrase buy term, invest the difference is where that comes from. For most people, there's no benefit, in my opinion, to having whole life insurance. Buy term, be a good saver. Once your net worth passes through a certain point, there just doesn't make any sense. They say you can borrow against whole life, but do the math. It doesn't. It's still costing you. The borrow is just it's how they slice and dice their projections on that. Another term under insurance that we should talk about, it kind of goes back to mortgages, is private mortgage insurance, otherwise known as PMI. So if you are buying a home, you don't put down at least 20% on the home, you'll be charged PMI, private mortgage insurance. Once the home value has at least 20% equity, then that PMI tends to drop off. So that's just to protect the lender in case you default on your payments. Typically, you want to pay attention to that PMI. I've seen PMI as low as $30 a month. I've seen PMI as high as $600 a month. So it depends on the property and the lender and where they're sourcing PMI. But typically, when you buy a home, you want to put down the 20% to avoid that monthly payment. Another type of personal insurance that we recommend a lot is umbrella insurance. Umbrella is a lot of people don't really know what this is, but it covers you beyond like home, auto, or boat. For instance, if you make a mistake and something bad happens.
Somebody gets hurt on your property, you have a car wreck, they can come after you if not some type of lawsuit above and beyond the amount of insurance that you had on that home or automobile insurance.
So if the auto stops at $500,000 and they insured you for or they sued you for $2 million, and you had because you had a $2 million net worth, let's say, then that umbrella policy protects you up to whatever amount you select. But if your net worth's $2 million, you should probably have $2 million.
Right. Yeah. If usually, probably if your net worth's over $500,000, it's something you should be looking at. You can buy it in $1 million increments, and it's fairly inexpensive for the amount of coverage and a peace of mind that you're getting with it.
Also, people don't think about this either, but umbrella insurance can protect your assets if someone sues you for slander or defamation of character. So it's not even just auto and home accidents. It's just other silly things you might find yourself in. Just be nice to everybody and drive safe. And buy term insurance or buy umbrella insurance. Okay, well, let's move into some tax terms. AGI. Everyone talks about AGI. What's your AGI? What does AGI include? Probably we need our tax expert here for this one, don't we? So when you fill out your IRS tax return, you get your standard deduction, right?
It's your adjusted gross income. I don't think we've covered that, considering it's another acronym there for you.
Oh yeah, that's true. AGI.
Not to be confused with MAGI, modified adjusted. Right.
The modified gets me. I have to go back to that definition every time I see someone use the modified. It's like, well, what did you modify of the AGI? So basically, it's your gross income. So the amount that you earned, less certain specific deductions. So most people would just be standard deduction or itemization. And then in the end, I think it's like a line 11 on the 1040. That is your adjusted gross income as deemed by the IRS. And a lot of times when you apply for things, they'll ask for your AGI versus growth.
And that's not just your work income. That can be other things as well. Pensions, interest on investments. That's all encompassing income there.
True. When you look at a tax return, who's a dependent? I mean,
well, in a family situation, it's your family unit, depending upon their age. But these are the people that are dependent upon you for their lives.
Yeah, it could be an adult relative that you support too.
That's why they depend on their.
Those are harder to claim, but that does happen or can happen if you structure it correctly. I alluded to it earlier when I said AGI, itemized deduction. When someone says I itemize or I don't itemize, when they say they itemize, what does that mean?
It means they're selecting their expenses throughout the year specifically in order to use those expenses to deduct against their gross income. So common ones were your home mortgage, for example. The interest you paid on your home mortgage was an itemized deduction. Another one might be the taxes you paid to your state and local municipality had been a deduction on your federal income tax form. So these are specific expenses that throughout the year that you have identified and listed on your tax return as a reduction to reduce your taxable income.
Charitable deductions as well. That's a big one.
That's a great example.
But you mentioned earlier just the standard deduction. That was doubled a few years ago. So, if you're not above that threshold, then a lot of people aren't itemizing anymore. It would be just if your itemized deductions were higher than the standard deduction where you take it.
Right. And that was the last on my list, standard deduction. Every year the government decides what the standard deduction is going to be. It fluctuates a little bit depending on who's in power and how they set the standard deduction. The last one, I guess, would be the Trump tax changes. Really made tax returns a lot simpler through the standard deduction. It made it a lot harder for people to itemize, and therefore people's tax return preparation probably got a lot cheaper because of that. Hard to get over the original standard deduction, but I think it was a little over $24,000 this year
as a couple.
Yeah,
about half that for an individual. So that's significant if you're not having to keep up with those receipts or try to plan that out for a lot of families.
Yep. All right, guys. Well, happy Financial Literacy Month, and I know you have a blog out there as well. You and Matthews, Brad did one I think last week. That's out there on YouTube and our website as well. And pass this along to young people who might need to learn a little more about basic terms and definitions. So have a great week. We'll see you next week.
Thank you.
Yep.
Weiser Wealth Management Incorporated is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance.